When you start digging into the stock market, you quickly realize that not all companies are created equal. In fact, if you want to protect your money and grow your wealth, you need to categorize every stock, and you look at into three distinct buckets: the good, the bad, and the ugly. Today I want to share my personal framework for spotting them, the specific example you need to know, and the exact mode of detection pattern I use to find businesses you can buy and hold forever. Let's start with the holy grail, the good business, what I called the investor's dream. A good business, it makes money easily and stays strong for decades. The secret sauce here is they sell a product or service that people must buy again and again. Because of that incredible brand loyalty and structure locked in, they have immense pricing power, meaning they can raise prices without losing their customers to their competition. And from a cash flow perspective, they need very little capital to keep running. Real world examples. Think of a Coca-Cola, people buy it daily. Apple's iPhone, an ecosystem people refuse to leave. Google search, a default habit for entire internet. How do you provide businesses actually good without just guessing? You look for what I call the Moat Detection Pattern. A true competitor will show all three of those signs together. High ROIC. Return of investment capital. It provides management converts capital into massive profit, and we want minimum 50%. High or stable margins. Competitors aren't forcing down or cut prices. Consistent free cash flow. Reasonable growth, no heavy dilution. They aren't constantly printing new shares and erasing your ownership, and strong balance sheet, little to no dangerous debt. Next up is the bad business. Now, bad doesn't mean it's going to bankrupt tomorrow. It's just barely decent. In a bad business, management has to work incredibly hard every single day just to stay completely average. They have low margins. It is incredibly hard for them to raise prices without losing clients, and their structural growth is painfully slow. And what might be real world examples? Think of construction companies or commodity businesses. The product is identical to everyone else. Think of it airlines before major industry consolidation, where passengers just buy the absolute cheapest ticket regardless of that brand. We have the ugly business. An ugly business is a cash-destroying machine. It is always struggling, generating low or even zero profit. The brutal truth about an ugly business is that customers simply don't care about the brand. Because they have zero pricing power and competition completely destroy their margins. They are trapped. To survive, they have to keep spending massive amount of capital just to stay alive. Combine that with heavy debt and you have a ticking time bomb.